What's up, guys? It's James Allen, the out-of-state investor, and right now there's a lot of growing concern amongst investors. We're already seeing interest rates rise at the fastest rates that we've seen in a long time. We're seeing inflation hit rates at the highest point in over 40 years, and on top of all that, we have an ongoing crisis between Russia and Ukraine, which has already done so and may continue to do so, have severe effects to the overall health of the U.S. economy. So today I'm going to be talking about the most important thing you can be doing with your money right now. This is what I'm doing with my money. This is what I highly recommend you should be doing with your money. And like I said in the title of this video, you need to stop buying stocks, stop buying real estate, stop buying cryptocurrency, and instead you need to do what I'm going to talk about in today's video. So before I get started, do me a favor and support the channel by smashing that like button. And if you haven't already done so, definitely subscribe and hit that notification bell to watch more content like this. And with that said, let's jump into it. Over the last 10 to 13 years, we've seen massive bull runs in the real estate market, in the stock market, in the cryptocurrency market, and we've seen a whole new wave of investors coming into the space as a result of things like YouTube University, even things like TikTok and Instagram lately, and especially in the real estate space because of things like biggerpockets.com, which helps educate so many people how to get started investing in real estate. Now, during this time period, many of these people that have started investing in the last 3 years, in the last 5 years, and even the last 10 years have experienced massive gains, but many of them have never gone through a downturn like an economic recession we experienced in 2008. So why am I saying to stop buying stocks, stop buying real estate, stop buying cryptocurrency? Because what I'm seeing a lot of inexperienced investors doing right now is they're over leveraging themselves. They're putting themselves in danger. If a market crash was to take place, they are not going to survive it. You know, Warren Buffett has a saying that when the tide goes out, you'll see who's swimming naked. Well, right now we are at the height of the market. Now, we don't know how much longer that's going to go on for. That's to be determined yet. But what we do know is it is more important now than ever to be adequately prepared for what may come, what could be a recession, what could be a potential crash. I've heard too many stories of people leveraging cryptocurrency only to get margin called, losing their money, people extending lines of credit on variable interest rates just to invest in cryptocurrency, doing a lot of high-risk investing, and especially when they have no emergency reserves or things of that nature to fall back on, these people are destined to lose their money. They're just asking for it. With that said, right now we're already seeing warning signs of a potential shift in the market, and that goes for the housing market, that goes for the stock market. We've seen the yield curve inversion take place. We've already seen the inflation go up to the highest point in over 40 years. We've already seen the interest rates go up over 200 basis points in just the last year alone. So with all these things taking place, we also got war with Russia going on as well. And so with all these things taking place before our eyes, these are red flags. These are warning signs. These are the signs of smoke before the fire takes place. And so it's more important now than ever to make sure that you are fundamentally sound before things continue to take the next step. We want to make sure that we're adequately prepared for a rainy day, that we're adequately prepared for what could be the worst case scenario. And so that way we don't lose everything we've worked so hard to build in the first place. So let me explain exactly what I'm going to be doing right now. But first, let me introduce you to today's video sponsor, which is Concreit. Concreit is an app that you can use to invest in private equity real estate investments from the comfort of your own home. Now, when it comes to investing in real estate, one of the biggest things that can hold you back is not having enough capital to get started or having the knowledge of how to do it. Well, with the Concreit app, you could start investing with as little as $1 into these private equity real estate deals without even having to be an accredited investor. Now, Concreit is registered with the SEC as a registered investment advisor, and they offer a 5.5% return on investment for the money that you choose to invest with them. One of the best things about investing with the Concreit app is you don't have your money tied up for 2 years, 5 years, or even 10 years like so many real estate funds out there. Instead, you have the ability to cash out of your position within a week's time should an emergency come up or you're just happy with the returns you've already made. To find out more information about investing with Concreit, download the Concreit app at the App Store or go to concreit.com. And with that said, let's get back to the video. If I go back to last March I purchased a primary residence for myself to live in. I was currently living in a primary residence, which I ended up keeping as a rental property. I moved out of there, rented it out, and then I started doing a full-blown cosmetic renovation on my primary residence. Now, this turned turned out to be great as far as building equity in the property, but the downside is I pretty much bled myself dry as far as my capital was concerned on a cash basis. Well, since then, my previous primary residence, which is currently a rental property, has gained a lot of equity. So there's a lot of dead money stuck inside that property, which I can utilize that money to make me more money and more investments. But in addition to that, I can actually use it to help reset my basic personal financial position, building up my reserves, making sure I'm in a healthy state financially so that I can continue to invest. Because what I always like to teach is that you want to invest from a position of strength, not a position of weakness. You see, one of the fastest ways to lose money investing is when you're investing from a position of weakness, so at least from a financial standpoint. You see, if you have no reserves and a big emergency comes up, you may be forced to sell some stocks or sell some cryptocurrency, and you didn't get to ride out what could have been a downturn, and you could have waited for it to go back up again, but instead you were forced to sell because of your poor financial health. So that's why it's so important to invest from a position of strength so that you're able to ride out for the long term and not making it a short-term investment trying to catch it at the right time. So for me personally, I want to be in the market for the long run because that's where the real gains are going to be had. That's where you're going to be able to experience that compound interest on an exponential level. And not only that, but it helps you to preserve your capital, which, by the way, that is the #1 rule of investing, is preservation of capital. You want to be able to hold on to your initial investment. And the more and more wealth that you start to build, the more that becomes important, that you want to play defense and you want to make sure that everything you've worked so hard to build in the first place, if you built $1 million or $2 million, you want to be able to preserve that capital so you don't lose everything you worked so hard to build in the first place. The first thing I'm going to recommend that you do if you want to be in a position of strength as you continue to invest in real estate or in the stock market or in the cryptocurrency market for that matter, is you want to have an emergency fund in place, because you don't know what can happen in these kind of environments. It could be very simple for the stock market to go down. Next thing you know, companies are starting to make job cuts. Next thing you know, unemployment's going up. Maybe you lose your job, maybe you lose some hours, and now you need money to carry you over, at least during the time period that you're transitioning from job to job. Well, that's where your personal emergency fund comes in. It's your rainy day fund, and it can help weather out any kind of storm like that to help get you from point A to point B, and that way you're not forced to sell any kind of investments just to help carry you over for that period of time. Another thing I'm going to highly recommend you do right now is eliminate margin. If you're investing in the stock market or the cryptocurrency market with margin, that means you're leveraging your money, okay? It's a bad idea to be doing that right now. All it takes is a violent swing, especially in cryptocurrency. This can happen very easily where it can have a violent swing of 30% down, 50% down, and now you can lose a lot of money. There's people that can lose even more money than they invested in the first place because they're investing with margin. So investing with margin at this stage of the market, very risky, very dangerous, and I would start eliminating that now. Another thing I highly recommend doing is eliminating bad debt. Now, what do I mean by bad debt? Bad debt is just simply high interest debt. So this could be credit cards, this could be personal loans. It just depends on the interest rate, but high interest debt is typically seen as bad debt. Now, this is generally good advice just regardless of the times we're in, but especially in high inflationary times. If you're living paycheck to paycheck now, imagine if food costs go up 10%, housing costs go up another 10%, cars go up another 10%, gas goes up another 10%. You could see yourself in major trouble to where you're losing money every month now instead of living paycheck to paycheck. And with credit cards, you could be paying 18% interest on that, 20% interest on that, sometimes up to 30% interest on your credit card payments. So that's an easy one to start working on paying down now. Another thing to consider is adjustable rate loans. If you have any of these, this could be a personal loan, this could be a HELOC. Many times these are tied to the market, and as the market rate goes higher, so do these personal loans, so do these HELOCs. And what we know is the Federal Reserve, they control what's known as the federal funds rate. They decide if it goes up or if it goes down. Well, recently they started raising this federal funds rate, which means that it becomes more expensive to borrow money, whether it's a personal loan or a HELOC. So their plan is they plan to continue hiking rates throughout the rest of this year and potentially future years from here on out. So the idea of low interest rates are kind of going into the past, and as we look to the future, we're anticipating that rates are going to continue going higher. So if you have the ability to go with a fixed interest rate instead of an adjustable rate, now is a great time to do that because we already know that the Federal Reserve plans to continue hiking rates. Now, if you aren't able to do that, I would recommend paying down your personal loans because they typically typically carry higher interest rates, but if you have a HELOC, they could be lower interest rates for your HELOC. But even with that said, you don't want to typically carry adjustable rate loans in high inflationary environments, because what happens is the Federal Reserve fights inflation by raising interest rates. So you can anticipate that as long as we have an inflation problem, they're going to continue to try to battle that by raising interest rates. Now, the next thing I'm going to highly recommend is particularly for real estate investors, because I have a lot of real estate investors that watch this channel. And so for those of you with real estate with a portfolio already in hand, I highly recommend having a minimum 6 months of PITI. That stands for principal, interest, taxes, insurance. Having at least 6 months of those reserves set aside for your properties. It could be obviously in case of emergencies like a roof needing replacing, an HVAC replacing. But with that said, the main reason why I recommend that much in your reserves for your properties is really the vacancy side of things. You see, if it gets to a point where there's a huge amount of your tenants that can't afford to pay rent, you start dealing with massive vacancies, that's really where you want to have those massive amounts of reserves in place as your portfolio continues to grow. Now, that will give you pretty good protection having that 6 months of reserves in case of a worst case scenario. But in order to be completely protected, you really need to go and analyze your homeowner's insurance. So when you're dealing with homeowner's insurance on a rental property, I'm going to highly recommend that you want to push the dwelling coverage. Okay, this is your first component, dwelling coverage. You want to push that as high as possible, okay, because that's the amount they're going to be able to give to you in the case of a worst case scenario. If your building caught on fire and you have to completely rebuild it, they're only going to pay you the amount of your dwelling coverage. So if that isn't enough, the rest of that money has to come out of your pocket. So it's really important that you accurately predict how much dwelling coverage you're going to need to make sure that you are in a good position if you need to rebuild the property. Now, the second thing you want to do is you also want to raise your deductible. So the higher the deductible, normally the cheaper the insurance. So you're going to go higher coverage on the dwelling coverage. That's going to make it more expensive, but you're going to go higher deductible to offset that a little bit. And that's going to mean a higher down payment. So if you could be, instead of $1,000 that you're going to pay and they cover the rest, maybe you're saying I'm going to pay $5,000 or $7,000, because at the end of the day, that's where your emergency fund comes into play, right? If you have $30,000 potentially in reserves, depending on the size of your portfolio, you can use that to pay for your deductible in a worst case scenario. And then the insurance company is going to take care of the rest. You see, the statistical likelihood of something actually happening is not that high. So you don't need to go so conservative to where you have a low deductible, to where you have a super high dwelling coverage. You can balance it out with a high deductible and a high dwelling coverage. So you are adequately prepared because you already have that emergency fund in place. Now, the third component you also want to look at with insurance is definitely your liability, making sure that you're covered in case of a situation with a tenant that comes into play. And that is so cheap to just put that amount up from $300,000, which is the typical they like to start at, up to $1 million. It costs like this much more money. Now, many of these things can actually be applied to a primary residence as well. Setting that dwelling coverage to a higher amount to make sure that you could rebuild your house if it ends up getting on fire or something bad happens to where you have to completely rebuild the house. That's not a bad thing to do for your primary residence as well. Now, with all this said, I know the initial title of this video is do not buy stocks, do not buy real estate, do not buy cryptocurrency. I'm going to take a step back here and say, look, you can buy those things. Buy stocks, buy real estate, buy cryptocurrency. Be in it for the long run at this point, because that is an absolute win-win situation if you can do that. But what I am saying, and what the main message of this video is make sure you are in a strong fundamental position at this point, because if things are going to take a turn, if things are going to start to go down in the stock market or cryptocurrency market or even the housing market, you want to be in a strong financial position to where you can weather the storm, where you can ride it out and not have to be forced to sell. So anyways, I hope you guys enjoyed today's video. If you did, do me a favor and smash that like button. And if you haven't already done so, definitely subscribe and hit that notification bell to watch more content like this. Also, let me know in the comments below, are you in a strong financial position? Are you ready to weather a potential storm? Let me know in the comments below. Finally, follow me on Instagram and TikTok at the Out of State Investor. Thanks again for watching, and I'll see you on the next one.